people are forced to either work and earn a living or stay at home and suffer. It's hardly unexpected that some people prefer to stay at home because of the dismal nature of some jobs. Small to medium enterprises are forced to close their doors at an increasing rate. During the pandemic, large chain retailers performed well. In other cases, they were even allowed to remain open during the entire event. Small business competition is no longer an issue for them. When it came to making a decision, money was always an essential factor. As the COVID-19 pandemic spreads, how much worse will the labor situation get? If you are new to our YouTube channel, please subscribe and click the notification bell to avoid missing new content. Dinero Association will regularly add videos to keep you posted on the latest in business and finance. Dealing with the great labor shortage. That young people were unwilling to work because they could rely on government assistance was one of the year's most popular fallacies. According to a small number of politicians and academics, people have too much money. Even though it was allowed by the pandemic, early retirement is having a significant impact on the labor market, and that's a fact. Statistics also show that baby boomers, not lazy millennials, are the primary cause of a labor shortage. Many people have left the workforce in the last 2 years for various reasons. Overwhelmingly, those who have departed and aren't expected to return are elderly individuals who have begun their retirement earlier than initially planned. Growth in earnings is likely in 2022, although not across all industries. We believe these factors will lead to higher pay growth in 2022. However, according to the most recent data, wage growth in 2020 and 2021 will be substantially lower than before the financial crisis. This is not surprising because of the prolonged period of political and economic instability. Because of the wide variations between industries and countries, wage growth in the Eurozone is more difficult to predict. The developing gap between the supply and demand of workers can be addressed in part by raising salaries, even if it does not fix the credential mismatch. Labor crisis could be the next pandemic. The US remains approximately 4 million workers short of pre-pandemic levels, despite the significant fall in the unemployment rate. Because the labor force is also less than before the outbreak, demand for labor is vital as the economy recovers, worsening the labor shortage, according to Gus Fauché of PNC. In the last quarter of 2021, there were over 11 million job offers, and employees were changing jobs at record rates. Employers are tense and eager to bargain to retain and attract workers in this high-stress environment. In the United States, hourly salaries rose by 4.8% last year, from $28.51 per hour in February 2020. Private sector workers in November earned an average of $31.03, up from $28.51. Wage increases are beginning to trickle down to growing prices for goods and services, which jumped 6.8% last year, the most significant annual increase in nearly 4 decades. When labor costs increase, raw material and product prices also increase, resulting in a cascading effect throughout the supply chain. When meat packing plants, for example, need to increase worker wages, they typically increase pricing to offset the increase. However, given the increased cost of meat, restaurants may need to increase their menu prices. According to the latest Producer Price Index released Tuesday, companies paid 9.6% more for goods in November. While various factors, including supply chain concerns, contribute to this increase, labor also plays a role. This has far-reaching consequences. 78% of small business owners have been harmed by inflation, and 63% had already increased the price of their products or services in the last year to compete. Confronting the labor shortage dilemma, the most alarming development was a drop in the percentage of working mothers who were employed. The U.S. Department of Labor estimates that 4.3 million Americans lost jobs in August. women's participation in the workforce has dwindled to 66%. There are far-reaching consequences to a scarcity of workers. All workers, skilled and unskilled alike, are affected by the current labor shortage. They have no idea where to go for management and mid-level staff in the best places. According to the data we have, our society's labor scarcity is a long-term trend, not just a short-term fad. Businesses are on high alert because a shift in why individuals are leaving their jobs. Employees who are disillusioned, heartbroken, or burned out may be unable to see the light at the end of the tunnel, regardless of how much money they earn. More than ever, people are reevaluating their life and making meaningful career choices. It's also important to note that job abandonment increases labor shortages in all industries. Supply is dwindling while demand is rising. In sectors like healthcare and technology, where attrition rates have increased by 3.6% and 4.5% in the previous year, organizations are afraid that there are not enough personnel to complete the work. There was 36% who resigned without receiving an offer from another employer, according to our research. To turn the great attrition into the great attraction, companies must consider 3 factors: which employee groups are leaving and where are they going, the potential ramifications of this exodus, and what they can do about it. Let's start with the first 2. What are the names of those leaving and where are they headed? Job hunting is dangerous, as it eliminates income and diminishes bargaining power in future job talks if you quit without a backup plan. It is more common for women and those earning less than $40,000 to be affected by this phenomenon. Rather than work in the gig economy or retire early, some people prefer to stay at home and take care of their families or themselves. In other words, a growing number of people are abandoning their typical jobs in favor of more self-sufficient activities or a vacation. As third-quarter corporate earnings report starts to trickle, investors are bracing for more healthy profit growth in the U.S. Other issues, including supply chain constraints and inflationary pressures, emerge as the economy recovers from the coronavirus outbreak. Analysts expect S&P 500 businesses' earnings to climb 29.6% year-over-year in the third quarter, down from 96.3% in the second quarter, according to Refinitiv's IBES. Third-quarter predictions are down from recent weeks, reversing an upward trend. Given the pandemic, analysts expected third-quarter profits growth to be lower than second-quarter growth, when corporations had easier year-ago comparisons. Please share and like this content and let us know what you think by typing your comments below. Keep your notifications open, and I'll see you on our next video.